Welcome, ladies and gentlemen. The worst market crash in history is approaching, so we must be prepared. The tech stocks had the worst start of the year since 2008. 40% of Nasdaq companies are down more than 50% from their all-time highs already, and there is more to come for sure. Valuations are at historical highs. Companies are raising billions based on fairy dust, and the Fed is signaling a tightening cycle. All of these are scaring investors that we are on the cusp of a repeat of 1999-2000 dot-com bubble. And if that was not enough, Goldman Sachs has rung the alarm bell. It is hard to imagine that 50% of all market gains since April are just from 5 stocks, and only 40% of the Nasdaq stocks are trading above their 200-day moving average. So the worst is indeed yet to come, and we are on the verge of worst stock market collapse in history. Stocks soared 360% in the past 10 years, averaging more than 16% per annum. No wonder valuations are near record levels. And now it is the time for things to cool down and reach a stage where pragmatism and reality are at forefront, while speculation and euphoria will go to the background. In this video, we will look at the following important points. Number 1, massive meltdown of Nasdaq companies and the reasons behind that. Number 2, how just 5 stocks have occupied the center stage in S&P 500 as far as the gains are concerned. Number 3, we will uncover some shocking truths by looking into the data that shows how close the current situation is to the dot-com bubble. And number 4, so finally we will look at the other side of the coin, meaning how we can create generational wealth by making use of the low prices that will be available to us when the fear and panic becomes extreme during the upcoming bear market. So let's go ahead and explore all these major events in detail. And if you have liked the video so far, smash the like button to bless the YouTube algorithm, and also be sure to subscribe and turn on the notifications. On this channel, I provide exceptional value to my viewers. I am on a mission to help you in acquiring skills and knowledge so that you can make your money work harder, smarter, and in long term. So in the long run, inflation is an investor's biggest threat since it erodes the purchasing power of money. Even a modest 3% annual inflation halves the value of money in 24 years. So outpacing inflation is the primary goal for long-term investors. Beating inflation was not a problem over the past decade since, as I mentioned earlier, stocks soared 360% in the past 10 years, averaging more than 16% returns per annum. But the party is about to end. During the pandemic, low rates pushed investors to pay higher prices for companies, due to which the market caps of several companies grew tremendously, irrespective of their viability as a good, solid investment and irrespective of the economy's strength. Low rates also made investors more willing to buy companies whose big expected profits may take several years to come to fruition. Tech investors may already be questioning their hopes for 2022. In fact, the Nasdaq has suffered its worst 3-day start to a year since 2008 and has lost in the range of $1 trillion this week alone. The massive meltdown has resulted in a storm that has taken the share price of 40% of the Nasdaq companies to more than 50% below their all-time highs, as I mentioned already. The extent of this chaos could also be gauged from the fact that the percentage of stocks in Nasdaq Composite Index that are down 50% below their 52-week high are already in the top 13% of all days since 1999. If you still think that we are not in a situation that is similar to the dot-com bubble, then think twice. We are indeed headed towards the worst market crash in history. And we must also keep in mind that 51% of all market gains from April through December of 2021 were just from the 5 most popular tech giants, that is Apple, Microsoft, Nvidia, Tesla, and Google. And a near record number of tech stocks have plunged by some 50%, a number that was only surpassed by the global financial crisis and the dot-com bubble. Valuations are at historical highs. Companies are raising billions based on fairy dust, and the Fed is signaling a tightening cycle. All of these are scaring investors that we are on the cusp of a repeat of 1999 and 2000 scenario. And now let's look at some shocking data which will further clarify the situation. A few days ago, with the Nasdaq at all-time highs, we saw a shrinking chart. Barely 40% of the Nasdaq's 3,000 plus stocks were trading above their 200-day moving average. As I mentioned earlier, Goldman Sachs then calculated that just the 5 most popular tech names, that is Apple, Microsoft, Nvidia, Tesla and Google, have contributed 50% of the S&P 500 gains since April of 2021. After contributing over double their starting weight to the index's return, these stocks now make up 22% of the S&P 500 by market cap, which is a 4% increase from the start of the year. And looking at the big picture today, the market is even more dominated by the tech sector than the 2000s. This is very important since it means that speculation has reached its peak. The market participants, in particular the retail traders, start believing in such circumstances that the groundbreaking tech companies will grow tremendously and will have a profound impact across various market segments which are targeted by them. But the problem is that as the hype increases, people forget that they just cannot pay any price for the expected or potential growth. Majority of investors don't even bother to look at the balance sheet of the companies in which they invest. They think that these companies that have business models around radical innovations will become unbeatable and grow to unimaginable levels with little to no consideration of the risk factor. So that is why in 2000 dot-com bubble, the tech companies were dominating the S&P 500 by 35% at the bubble peak, but now it is even higher and the dominance of tech companies is sitting at 42%. Now you might be wondering, what is the reason of the recent sell-off? So the rising interest rates, expectations of strong economic growth and inflation are all key factors that contributed to the sell-off. But let's dig a bit deeper and have a look at what is going on beneath the surface. It is important to understand why tech skyrocketed to begin with. When coronavirus hit in 2020, central banks slashed interest rates and pumped trillions of dollars into economies. Bond yields shattered, so investors started to look elsewhere for returns. The banks and energy companies, etc., were in the doldrums, so investors turned to the tech stocks like Amazon, Apple, Google, and apart from these established companies, the investors also started to look towards many new tech companies which started to pop up like mushrooms across the globe. And since the interest rates were low, meaning the borrowing was cheaper than ever, investors thought, why not take a bet on flashy tech companies that might be the next Netflix, Amazon or Google? Fast forward a year and the situation has changed drastically. Let's see why it is the case. The Fed has signaled that it is going to raise interest rates in 2022 and has already started slowing bond purchases as it tackles the strongest inflation since the 1980s. So the trigger for recent sell-off was the release of minutes from the last Fed meeting in December, which sent investors into a panic. The rising interest rates and the resulting higher bond yields hurt tech stocks for a few reasons. The main reason is that many technology companies are currently unprofitable or make little money. If bond yields are higher, then investors are losing out on returns by holding tech companies that are expected to start earning in the distant future. In this scenario, the tech companies become less appealing. The higher interest rates are also good for financial sector, and these factors divert the attention of investors from the tech sector. Now, all tech companies are surely not equal. Analysts expect stocks such as Apple, Amazon, and Google to fare much better in 2022 than unprofitable tech companies because, simply put, they generate enormous revenue. Now, the new tech companies and other risky assets have seen astronomical increases over the past 12 months. Cathy Wood, known as the queen of retail traders, pumped many companies to stratosphere. These included companies having little to negligible cash flow, or even worse, many of them are in the embryonic state and have no traction in their targeted market segments. And it is not just about the stock market. Let's look at the non-correlated assets also. Elon Musk pumped meme coins like Dogecoin to Mars. The companies which saw most accelerated price increases during this euphoric bull run will definitely plummet the most and most aggressively as the bull mania is handed over to the bears by the market participants. I firmly believe that the stock market will crash 80 to 90% as mentioned by Harry Dent, who is the founder of HS Dent Publishing. So what shall we do? How can we prepare ourselves so that we don't lose our capital? We all know that every bear market is followed by a rebound. And it is the bear market where the fortunes are actually made. So we will have an opportunity of a lifetime in around late 2023 or so, where we will see the stock prices of solid companies well below their intrinsic value. And as far as the cryptocurrencies are concerned, over 90% of altcoins will vanish in the dust, as it happens in every crypto bear market. Only Ethereum, Bitcoin, and a few other cryptocurrencies with solid use cases will survive. And that will be the time to accumulate for the next bull market. When people start selling those financial assets, wealth disappears and people panic more and more. So the financial assets crash actually triggers recession, which is what happened in the 2000 crash. For many people, this will be the time to accumulate the stocks and cryptocurrencies at extremely low prices. I hope that you liked the content of this video. If you would like to see such videos with my unbiased opinion and my own unique style of analyzing stocks, please drop a like, subscribe to my channel, and I will see you in the next video.